Welcome to the Rational Edge. Today we're doing a deep dive into something absolutely critical for organizational trust. We're looking at the mechanics of how a modern business handles its financial data. And just as importantly, how it protects that data from, well, compromise. We are unpacking what you could call the twin pillars of business integrity: the accounting information system, or AIS, and internal control. We find the best way to maybe frame this relationship is through biology, actually. We see the AIS as the organization's nervous system. It's the network, the pathways carrying every bit of transactional data, instantly connecting sales to inventory to cash. And internal control, that's the company's, let's say, highly evolved immune system, making sure everything is sound, safe, reliable, guarding those data signals constantly.
That framing is, I think, really essential, especially for you, our listener, because, well, most people just think of the AIS as the software. But that's just too narrow, isn't it? It's a total system. It encompasses the people, the procedures they follow, the raw data, the tech, yes, but also, crucially, the internal controls that are physically embedded into the software and processes. The AIS is really the engine. It takes millions of daily transactions, invoices, payroll, you name it, and automatically aggregates and transforms them into reports. Reports that management and, external stakeholders can actually trust.
And here's why it's so necessary, right? If you're a tiny operation, maybe you handle everything manually, spreadsheets, paper. But the moment a company needs to scale, that manual approach just collapses. It can't keep up. The AIS steps in not just to speed things up, although it does that, but to enforce absolute consistency, structure. It automates the recording, the summarizing, the reporting, so a complex operation can actually function without drowning in, well, messy, decentralized data.
Okay, so let's unpack that nervous system idea a bit more. The AIS. It's meticulously designed, as you said, to cover the entire accounting cycle, from the very first trigger, the transaction itself, right through to the final financial statements. And the foundation of that design is, well, it seems like an almost obsessive level of organization. For efficiency, sure, but also for a complete verifiable trail.
Exactly. That organization is what separates a reliable AIS from just, a pile of disorganized data or spreadsheets. And if you look at how these digital systems structure the information flow, it's really all about creating efficiencies through specialized processes.
Yeah.
This is where the concept of special journals comes into play, even in a digital sense.
Okay, special journals.
Right.
Right. In a digital world, this sounds less like old paper ledgers and maybe more like highly efficient database indexing or something. Why does that specialization really matter for a modern AIS?
It matters because of sheer volume and speed. Just imagine if a company like Amazon had to log every single sale in one giant monolithic general transaction file. It would be incredibly slow. And the chances of data input errors, they just skyrocket. Special journals are like dedicated high-speed lanes optimized for specific high-volume recurring transaction types.
Okay, so a lane just for cash receipts, maybe one just for sales, one for disbursements, one for purchases,
Mhm.
those mean ones.
It's exactly the typical four. That specialization immediately reduces recording mistakes, data entry issues, and it allows the system to process information just incredibly rapidly. Now, that takes care of the speed. But what about the detail? If I'm reporting, say, the total accounts receivable for my balance sheet, I need that big aggregate number, right? But I also absolutely need to know which individual customer owes me what part of that money. How does the AIS manage that simultaneous need? The big picture and the granular detail. So where you see a really brilliant separation of summary and detail. And it actually doubles as a crucial internal control feature. The general ledger holds the total summary number. We call that the controlling account. Let's say the total accounts receivable. That's your high-level financial snapshot.
Got it. The single number that goes onto the financial statements for everyone to see.
Precisely. Meanwhile, all the specifics, every single individual customer invoice, every payment received, that's meticulously tracked in what we call subsidiary ledgers. Now, here's the powerful control feature built right in. The balance in that controlling account must always instantaneously equal the sum of all the individual balances in its related subsidiary ledger.
Which means if those numbers are off by even a tiny amount, even a cent, you get an immediate, like, flashing red light alert.
You know instantly something has gone wrong. No ambiguity. Either a simple error occurred in posting somewhere, or more worryingly, maybe someone tried to hide or manipulate a specific customer record without adjusting the overall total. This mechanism is a key self-checking control. It ensures accuracy while maintaining both speed and detail. It's quite elegant, actually.
Okay, fantastic. So we have established the structure of the nervous system, the AIS, how it handles speed and detail. But like we said, that speed means nothing if the data itself can't be trusted. So let's pivot now to the immune system. Internal control, or IC. IC is what makes sure the data flowing through that super fast AIS hasn't been, attacked, corrupted, messed up, or even just misinterpreted along the way. The source material defines internal control not as some static checklist you tick off once, but as a continuous process, something management puts in place and has to oversee constantly. And its goal is critical, to provide reasonable assurance that the organization's objectives are met. Now, reasonable assurance. Why reasonable? If we want trust, shouldn't the goal be absolute assurance?
Well, that comes down to practicality and cost. Absolute assurance is, for all intents and purposes, impossible to achieve. And perhaps more importantly, it's financially prohibitive. Controls cost money. They take time, resources, personnel. There's a point of the diminishing returns where the cost of adding yet another layer of security outweighs the tiny bit of extra risk you might mitigate. It just doesn't make business sense past a certain point.
But doesn't the sheer complexity of modern tech, especially in these lightning-fast systems, mean that management might struggle now to accurately judge that risk-cost balance? Is it harder now?
Oh, it makes it harder. Absolutely. No question. And that's precisely why risk assessment has to be continuous, not a one-off exercise. But we also have to be realistic and account for inherent limitations. Controls aren't foolproof. There's always the possibility of human error. Someone just makes a mistake. There's a risk of management overriding control if they're determined to. And of course, there's collusion, two or more people working together specifically to beat the system. So IC is fundamentally a balancing act. It's designed to reduce risk down to an acceptable level, so the business can still operate quickly and efficiently. It's not about eliminating risk entirely. Now, this immune system, this internal control structure, it's driven by three really clear objectives, three things it works constantly to protect. The first is operations. This is all about making sure business processes are effective and efficient. It also includes safeguarding all the company's assets, cash, inventory, equipment, and increasingly important intellectual property. Our process is running smoothly, our assets secure from theft or waste or damage. That's operations.
Right. So basically making sure the engine runs smoothly day to day and nothing valuable walks out the door.
Exactly. Well put. The second objective is reporting. This is the integrity component we talked about. We are ensuring that financial data is accurate, reliable, and timely. This is really the foundation of external trust, making sure those financial statements are true and complete.
Yeah, absolutely crucial for investors, lenders, regulators, anyone making decisions based on those numbers.
Absolutely. If the data is garbage or even just perceived as unreliable, the trust evaporates very quickly. And the third objective is compliance. This means simply following all the rules. Laws, external regulations, think about things like data privacy rules like GDPR or CCPA or environmental standards, and also the company's own internal policies. These three objectives together, operations, reporting, compliance, they really form the bedrock of organizational health and trustworthiness.
Okay, got it. So we have the goals: effective operations, reliable reporting, and solid compliance. Now let's dig into the how. How does management actually achieve this? They need a robust framework, right? And that framework, often referenced through standards like COSO, I believe, has 5 key components, 5 pillars that hold it all up. Let's start with pillar number 1. The control environment. This sounds like the overall ethical foundation. The tone at the top. We know intuitively if senior leadership bends the rules, then others might feel okay doing it too. But beyond just saying the right things, how does management practically demonstrate commitment to integrity and competence? What's really at stake if they fail here?
The stakes are enormous. We've seen it time and again in major corporate scandals. If the tone at the top is weak, or worse, ethically compromised, no amount of clever technical controls can ultimately save the organization from regulatory trouble, or even collapse. The control environment really is the most human element of the whole system. It's demonstrated through how the organization is structured, how they assign authority and responsibility, crucially, how they hire, train, and reward people. I mean, do they reward results regardless of how those results were achieved? Or is ethical conduct paramount? If the underlying culture is corrupt or indifferent, the controls are basically doomed from the start. Building on that foundation, pillar 2 is risk assessment. Management cannot just sit back. They have to proactively identify what internal or external risks could actually prevent them from meeting those 3 objectives we just discussed.
Right. Things like maybe a key supplier suddenly going bankrupt, or a critical network failure, a hack, or even just internal process changes, like rolling out a new software module that creates unexpected vulnerabilities.
Precisely.
Right.
All of those. And once those risks are identified, the system moves naturally to pillar 3, control activities. These are the actual checks and balances. the specific actions designed to mitigate the risks that were found during the assessment phase.
Gotcha. These are the practical daily actions people take. And the source material really highlights one as being perhaps the most important: segregation of duties, or SOD.
SOD is absolutely fundamental. It's the bedrock of financial control, truly. The idea is actually quite simple. You ensure that no single person has control over the entire life cycle of a transaction, from beginning to end. Take a company's purchasing process, a classic example. You absolutely must have separate individuals responsible for, say, requesting the goods.
Okay, step one.
There's someone else approving the purchase.
Step two, different person.
Then another person physically receiving the goods when they arrive.
Step three, confirmation.
And finally, yet another person authorizing the actual payment to the vendor.
Because if one person controlled all four of those steps, well, the temptation or just the opportunity for error is massive. They could easily invent a phantom vendor, couldn't they? Order goods for themselves, mark them as received by the company, approve the payment, and cut a check to their own shell corporation.
That's the classic fraud scenario it's designed to prevent. SOD ensures that to commit and conceal fraud, or even just a major error, you now require collusion. You need two or more people actively working together. That significantly raises the difficulty and, crucially, the risk of being caught. It's a surprisingly elegant, almost low-tech way to guard a high-tech system.
That makes perfect sense. What other key activities generally fall under this pillar, beyond SOD?
Well, we're talking about things like proper authorization levels. Who has the authority to sign off on spending $1,000 versus $1 million? That needs to be clearly defined. We also include physical security controls, things like locking up high-value inventory, securing server rooms, access badges, and very importantly, periodic reconciliations, things like matching the company's internal cash records against the external bank statement every month, finding discrepancies quickly. Moving on, Pillar 4 is information and communication. This sounds vital for integrating the nervous system, the AIS, with the immune system, the controls. We need assurance that the AIS is feeding good, reliable, timely information to the people who are actually performing the control activities, right?
Exactly. The control activity itself is useless if the person assigned to do it is working with garbage data from the system. Or maybe they don't even fully understand what their control responsibility is because it wasn't communicated clearly.
Precisely. The information generated by the AIS must be accurate, it must be timely, and it needs to be communicated clearly to the right people so they can perform their designated oversight tasks effectively. The systems have to talk to each other and to the people.
Okay, and the final pillar, number 5, is monitoring. Makes sense. We can't just set up this perfect system of controls and then just walk away and assume it works forever, can we?
No, absolutely not. Monitoring is the ongoing reality check. It's the continuous improvement loop for the entire internal control system. Management, usually supported by others, must constantly ask, are the controls we designed months or years ago still effective? Has the business changed? Has the regulatory environment shifted? Did we miss a risk initially? We need to continuously review and adapt.
And this review function, this monitoring, is often spearheaded by internal audit teams, isn't it? Providing that independent assessment back to management and the board, confirming whether the controls are actually working as intended.
That's exactly right. Internal audit often plays a key role here. They act almost like the quality assurance department for the immune system. They often adhere to global standards, like those from the IIA, the Institute of Internal Auditors, to ensure that the entire control structure remains relevant, effective, and responsive to the company's changing risk profile.
Wow. Okay, we've covered a lot of ground here, really laying out the architecture of organizational trust. The core connection seems absolutely unbreakable. The AIS provides the speed and efficiency needed for modern business, while internal control ensures the integrity and reliability of the data flowing through it. This partnership seems like the active, ongoing guarantor of business health and trust.
That's really the key takeaway for you, our listener. When you look at any large company's financial reports, remember you are seeing the end result of this incredibly complex, interwoven system. A system where technology and strict procedures have worked hand in glove, hopefully, to verify the veracity of every single transaction that underlies those numbers. It's a system of trust built on layers upon layers of automated and human checks.
A vital system indeed. So to recap quickly, AIS as the complex nervous system, internal control as the vigilant immune system. IC provides reasonable assurance through its 3 objectives: smooth operations, reliable reporting, and solid compliance. And we walked through those 5 foundational pillars supporting it all. The control environment, tone at the top, ongoing risk assessment, Crucial control activities like SOD, clear information and communication, and continuous monitoring.
Right. So maybe here's a final thought to consider based on those 5 control pillars we discussed. We know that a fast-growing, especially tech-focused company often prioritizes speed, innovation, getting the next product out the door. New technology is key. Given that intense focus, which of those 5 pillars, environment, risk assessment activities, information communication, or monitoring, which one do you think is the easiest for that kind of company to accidentally overlook or underinvest in?
That's a fascinating challenge. Where might the blind spot be?
Well, is it perhaps the very human-centric control environment? Because, culture and ethics don't install with the latest software update. It takes continuous effort. Or maybe it's monitoring. Because it's just easier to assume that the existing controls, especially the automated ones, are still working fine, rather than taking the time to regularly test and validate them. Something to think about. And consider this follow-up. Why might overlooking that specific pillar be the most damaging thing for long-term trust, especially when that company relies so heavily on the speed and the immediate efficiency of its shiny new accounting information system?
Let's wrap up today's deep dive. See you next time.